scary PowerPoints and a view of the equity market that has allowed people to be invested given their fears. Let's do this. Let's bring it up right now as we can. Our money must read here from Calvasina. It's from front of our 80-page PowerPoints. It's like Mary Meeker on steroids. Lori Calvasina. Our main sentiment model points to a gain of 10.8% over the next 12 months. You look here at the drawdown, 50%, great financial crisis, World War II, 40%. And then you got to get out front and still be optimistic. Do you fear the big drawdown?
So our base case has been we're going to be higher over the next 12 months, but it's not going to be in a linear fashion. And we assume that we're going to have at least one, maybe more drawdowns of 5 to 10%. We call that tier 1 on our tiers of fear framework. Yeah. What we do, as sort of things come up in the market, right? We'll look at what we call tier 2, tier 3, tier 4, and sort of evaluate, is there a risk of falling into one of those? Not because we're telling everybody, especially sort of in retail, investor land, to sell, but to be prepared for what might happen.
Your job is to go out and talk to people and say to them, let the fear go, let it go, let it go, let it go. They're frozen because they're worried about that big drawdown. What percentage of us are worried about a negative 35% bear market?
So if you look at the Conference Board survey that just came out, they actually have a question that gets very, very little attention, but I like it a lot, and it's on stock market optimism going forward. I forget the exact number, but it's still extremely elevated, and it actually ticked up just a little bit. It hit a new high in late 2024, and it's been kind of hovering around that level ever since. So when we look at that as a gauge of retail investors, we think that they're not too worried. Now, if I talk about institutional investors, we might look at something, say, the CFTC futures positioning data, which is easing. You had seen sort of one standard deviation above the long-term average. Basically, that's, complicated speak for saying people were feeling good and well-positioned, but not crazy, not euphoric. And that's easing down. It doesn't look under-owned. And I would say there's some nervousness creeping into the institutional community, but I don't think there's panic there either.
So you serve institutional investors, but I know that one thing that comes up a lot in those conversations is the role of the retail investor and how they influence the market overall. Retail stock ownership, I think, is at a 20-year high. How do you think that's changed the stock market over your time covering it?
It's interesting because when I started back in 2000 and at a different firm, and I remember being taught, by a very seasoned, extremely bright strategist that you would look at the retail funds flow data and do whatever the opposite was, right? So if they were all buying, you'd sell, and if they were all selling, you'd buy. And I don't think it quite works that way anymore. I do think retail investors have gotten much more sophisticated in their understanding of financial markets. There's a lot of innovation in the industry that's helping people out. And we were talking earlier about how I travel. I run into people in airports. I run into, people who are driving me places, and, talk to people on airplanes. And people sometimes, will start talking about the stock market, and they know a lot. And I think that's very different from early on in my career, when sort of the purview of all the intricacies of our industry were really just limited to the institutional community.
Okay, so it's changed a lot in your 20-plus years, but is it going to look like Korea? You look at the Korean stock market, and it had a bananas week, right? It was down 10% on Tuesday. It surged 16% overnight. Year to date, it's up massively. Retail investors are a huge presence there. They love the AI trade. They love these leveraged single stock ETFs. Is that what the U.S. stock market is headed towards?
It's hard to say. I don't see that right now. I feel like we have more guardrails in place. But the reality is that if you look at sort of this theme of democratization of the equity market, we got a lot of color on that from financial companies in this reporting season, talking about new instruments and why they might be doing one thing or another thing. Did retail want it? Did institutions want it? Was it something, they should be doing? Sports, right, for example, in prediction markets was something we saw a few companies say we're not going to do, even though there might be appetite for it. But I do think this trend of getting typical Americans engaged in the stock market, I don't think that's changing.
What would you do as a retiree now? The old rule was take 4%, be happy, move on, maybe buy an annuity, whatever. What's the RBC advice for someone with an equity pot and how to manage it given that retirees never die?
Well, I think the first thing you always do is, and this is always my first advice for people, is work with a financial advisor. And I think even in my purview as sort of an equity person, I would want sort of that advice on diversification.
Why, the distance?
I think that I know a certain corner of the market very well, and there's a certain corner of the market I don't know very well. So I would want some advice, frankly, to come in and sort of balance me out. But I do think staying diversified is something that just makes sense, and not trying to play the short term, not trying to play every little twist and turn.
How do you not play the short term if you're watching Bloomberg Surveillance or 5 of Scar's media properties religiously, but you're supposed to be long term? How do you do that with modern media?
This goes back to our tiers of fear, right? And so typical drawdowns are 5 to 10%. Be prepared for those. And there's always a big test once you kind of get to 9%, 10%. Are you going to go lower? And what we tell the institutions, and I tell this to FAs I talk to as well, is if you don't think that there's a serious chance of a recession, or these days we're also talking about interest rate shocks, then you're probably going to bottom out at 10%. But if there is something that's unknown that happens in the market, right? If you looked back at 2018, we had tariffs for the first time. We had some concerns about the Fed. We had a 20% drawdown. We have these growth scares that can go to like the 15 to 20% range, but just kind of know what's coming. Be educated ahead of time, be prepared, and don't overreact in the moment. If you don't think that there's, sort of a serious chance of a recession, and we talked a lot to hedge funds about this last year around tariffs, then you're probably not going to have like a 25 or 33% type drawdown, which is what you see in recessions. Kind of 20% might be the worst. And so it's really just being educated and knowing that markets can be volatile, and what do these different levels signify, and just, again, not overreacting in the moment.
Individual investors seem to have mastered the art of buying the dip. They come in, they are kind of, they don't get rattled by stock market declines. They come in, they're like, I'm buying, I'm buying. Have institutional investors looked at that and kind of adjusted their behavior as a result?
One thing we've noticed is that there are certain valuation gauges. We can look at PEs and where they typically bottom out at, and on certain charts they make higher and higher lows. And I think that's because of these dip buyers coming in. So you do have to have it in the back of your mind.
What you just said, I disagree with. Not you, but I disagree with the zeitgeist that we've learned something new. We haven't woken up on a Monday being down 22% or being down 35%.
Is the government going to let that happen?
Well, that may be. That's an Eric Balchunas question. But, Lori, I think we don't have a collective memory of a massive drawdown anymore, and our behavior will change if we get that.
Well, I take your point. We have a lot of conversations, I would just say in the financial community about when did you start? So I started in 2000. I didn't see the tech bubble melt up, but I certainly saw the other side of it.
You enjoyed 2008-9.
Yeah, I lived through it, right? I remember.
She didn't enjoy, she lived through it.
I lived through it. I remember being in conference rooms, I want to say like in 2006, with mice running across the floor, and home building companies talked to packed rooms, and you couldn't, you were violating some fire code, right? Because there were too many people. And so I remember the height of that bubble, very clearly. And I do think there's a lot of people in the institutional community who weren't around for the GFC, right? Who weren't around for the tech bubble. So I take Tom's point, but remember, we did have a massive drawdown around COVID, which was a typical recession type drawdown. And it was interesting. I mean, we've done a lot of work around that, especially, as kind of the Middle East situation has flared back up. And I reminded people, I said, we did a recession's worth of decline in about a month.
Good point.
And I think people have kind of forgotten about that one, but you can see how fast and steep and difficult, frankly, those kind of declines.
2022 wasn't pretty either.
No, that was a weird one. We've had trouble classifying that one, in sort of our tiers. We think what essentially happened was the misery index spiked because of inflation. It felt like a recession. It wasn't. You got a recessionary type drawdown in the market, and you also had a massive interest rate shock. Just expectations of Fed hikes piled in, and you threw a war on top of that, right? It was a little bit worse than a growth scare, not quite as bad as a recession, but pretty darn close.